Joe, I'll go to you first just because you're sitting to my right here. Your read in on the data that just crossed on the employment situation.
The Fed's going to hike its policy rate by 25 basis points when it meets in May. I think that's the primary takeaway. Look, a 3.5% unemployment rate, pretty much status quo, a strong, albeit cooling job market. This is what you want to see, but it's necessary but not sufficient for the Fed to actually declare, hey, a peak. Wages, what we were at 4.2 on a year ago basis, 0.3. I want to dig in a little deeper. I think we're going to have a 3 handle on a 3-month average annualized pace. That gives you a sense, I think, of where, one, the risk of a wage price spiral is. That means it's diminished. That's actually good. That means we will get a near-term top in that policy rate peak. But look, demand's still stout for workers. We're short workers in all kinds of, service industries. So we have a tight labor market. Inflation's cooling, but not cooling fast enough.
Emily, what do you think? Do you agree the print coming in slightly above expectations? Unemployment, 3.5%, really pointing to the fact that the labor market remains very tight.
Yeah, Sean, absolutely. The U.S. labor market is undoubtedly the strongest pillar of the U.S. economy today. And in fact, we just beat expectations in the non-farm payrolls report for 12 months in a row. And that's a streak that dates all the way back to 2000. So no doubt about it. And we are seeing the bond market reprice expectations, as Joe mentioned, for what the Fed's going to do in May. We were looking at about a 50-50 chance of another 25 basis point rate hike versus a hold in May. And now I'm looking at the bond market expectations, and 25 basis points is now the base case. I'm looking at the 2-year Treasury yield this morning. We're up about 12 basis points. Another reflection that the Fed still has some work to do here.